Hey guys, in this video, we are going over 3 stocks that Warren Buffett either already owns or would be proud to own. I'll dive into the fundamentals and analysis of each of these companies and show you why they actually match Warren Buffett's investing style. Make sure to watch all the way through to get an idea of why these stock picks could be very strong, and also why they could be reliable growth stocks that you can actually add into your own portfolio. So we all know Warren Buffett, the king of investors, and probably one of the most influential people to ever live in the stock and investing world. At 89 years old and with a net worth of about $70 billion, some would say that if there were a god of investing, it would actually be him. He's the CEO of Berkshire Hathaway, which, along with a terribly simple website, fully owns companies such as Geico, Fruit of the Loom, Duracell, and Dairy Queen, and also owns a large percentage of companies like Kraft Heinz, American Express, Wells Fargo, Apple, and Bank of America. He's known as a value investor, preferring to invest long-term in companies with strong financials. He's especially well known for actually investing in companies that are currently trading below their intrinsic value and holding them and building them until they actually reach their real value. You're never going to see Warren Buffett investing in companies like Tesla, where speculation and potential future growth seem to outweigh all the shortcomings on their balance sheets. And though he used to be a large shareholder of the 4 largest US airlines, he actually revealed at his latest shareholders meeting that he had sold his entire position of US airline stocks. He said that basically they just rarely sell portions of a company, and if they do want to get out of an industry or company, they'll likely just sell all their shares. And sell he did, though he did end up losing a significant amount of money with the sale. These airline financials just do not look promising to Warren Buffett, and he thinks that even the current values of the stocks are not justified based on the numbers. So here are some things that he actually swears by. One is finding quality companies with a competitive advantage. Warren Buffett hates buying companies that are not strong, and he absolutely will not buy companies that do not have a competitive advantage, which he actually calls a moat. Second is he says that you should invest like you're actually buying up the entire company. Now, of course, most of us trading these stocks, we can't afford to buy up a whole company, so we're just purchasing individual shares. However, he says you should treat this like you are actually buying the company. Is it a good buy? Are you buying at a discount, or are you overpaying for the company? So to do that, you must also look at the book and intrinsic valuations. Third is you must invest in what you understand. I think this is very important for a lot of investors, because a lot of people just buy a stock based on its name without really knowing what the company does, its current balance sheet and financials, or the industry as a whole. This really magnifies the importance of due diligence, and that is doing your own research and coming up with your own conclusions. And his 4th rule is keep cash on hand. Always have a good amount of cash available on hand in case investment opportunities do come. Yes, some aggressive investors would actually not hold on to too much cash because they do want to leverage their money. If you're holding on to cash, that means the money is not currently invested and growing. But of course, there is a trade-off between risk and safety. Holding cash can definitely be a safer way to invest, especially if you're keeping up to date with the markets and know what to invest in. So let's go over 3 stocks that fit his criteria, and I'll give you my opinions on each one, as well as why you might want to add it to your own portfolio. So number 1 is Apple, AAPL. Warren Buffett currently owns about 5.7% of Apple, which equates to about $75 billion worth of shares. This is his biggest holding in a company that he truly loves. So currently Apple is trading at $299.42 with a 52-week low of $170.27 and a high of $327.85. They currently have a market cap of $1.298 trillion and a beta of 1.17. This means that Apple stock trades at just about normal volatility. And right now they have a current PE ratio of 23.53. Their earnings per share is actually quite a bit higher than it should be. And this is because Apple loves to buy back its own stock. The dividend yield for Apple is currently at 1.13% based on its current valuation. If we take a look at the 6-month chart, you can see that it hit its high at the start of 2020 and then dipped down to the low 200s in mid-March. Since then, it's recovered back to about 90% of its all-time highs. Note that Apple has beat its expected earnings for at least the last 4 quarters. But you can also see that they did not issue any guidance for Q2 of 2020 due to the uncertain markets. And in 2019, they had a revenue of about $260 billion with profits of around $55 billion. Let's talk about some of the news right now, and later on, I'll go into a more in-depth analysis. So with the up-and-coming 5G network, Apple is supposedly pushing back its newest iPhone 12 by about 1 month. This means that we should expect these new phones by October. In terms of growth, Apple's services revenue is up 17% to $13.35 billion for the March quarter, and their wearables and accessories division also gained about 22.5% to $6.28 billion in the same quarter. Now, going back to why Warren Buffett loves Apple so much. He actually normally does not like tech companies at all. It's a sector that he doesn't really understand, but he likes to view Apple as a consumer product company. He says that he believes Apple is the best business in the world and would love to own the entire company if it were possible. He loves the customer loyalty, expanding services, high profit margins, and extremely strong balance sheet. Speaking of balance sheet, let's do a quick but deeper analysis at this company's financials. So Apple's current enterprise value is $1.29 trillion. Right now, this is just about where the market cap is. And we talked about how Warren Buffett likes buying companies when they are currently under the enterprise value. So right now, it is a toss-up whether or not he would currently invest in Apple. Also, take a look at its forward PE ratio of 24.27. This means that its current share price is 24.27 times the expected earnings per share. So yes, they are expecting earnings to go down this next quarter. Apple also has a very high price to book ratio of 16.13. This means that the market cap is 16 times higher than the book value of the company based on its balance sheet. Let's also take a look at their profitability, as this is extremely important. Apple currently has a profit margin of 21.35% and an operating margin of 24.48%. These are very solid margins and shows that Apple has really streamlined its manufacturing process. And as a result, they are getting a very good profit margin on their products and services. Another value I like to look at is the current ratio. And you can see that for Apple, it's currently 1.5. Current ratio is basically the current assets divided by the current liabilities. If we're looking more at the long term, we can also take a look at their total debt to equity, which is their total liabilities on top divided by the shareholders' equity. Higher numbers means higher risk to shareholders, so 151 in this case is very high. Note that some industries like tech do tend to have very high DE ratios. Now, why do I think Apple is such a great long-term growth stock? Well, I just don't see Apple loyalty going away anytime soon. I used to not use Apple, but once I started buying their products and getting into their ecosystem, it's just extremely hard to get out. Everything pairs together and works really seamlessly. Give the stock a consideration if you do agree with Buffett, but right now the question is it the right time to buy at its current valuation? But in the long term, Apple is not going anywhere, and its iPhone will remain super popular with their loyal customers. Okay, next up on my list is VOO, and this is actually not a certain company stock. It's actually an exchange trade fund, ETF. Now, if you guys have seen any of my other videos, you'll know that VOO is my favorite ETF of all time. VOO is Vanguard's own S&P 500 fund. Now, Warren Buffett doesn't own any of VOO, at least as far as I know, based on Berkshire Hathaway's public data. But index funds are what he actually recommends most investors buy as the majority of their portfolio. He believes in America as a whole, and he's made that very clear in both his 2008 and 2020 shareholder meetings. One of his biggest messages is that you cannot bet against America. This optimism means that investing in America's largest companies as a whole is one of the safest and most effective ways to buy an investment, hold it, and let it grow without even thinking about it. Let's take a look at VOO's price history. Right now, it's trading for $265.30 a share with a range of $200.55 to $311.59 in the last 52 weeks. It's actually down about 11.48% year to date due to the coronavirus, which to be honest is not too bad considering what we're going through. When you do invest in an S&P 500 index fund, it really doesn't matter which one you buy. They all perform relatively similar. However, the most important thing that you do need to be looking at is the expense ratio. So the reason why I love VOO so much is because of its extremely low expense ratio of just 0.03%. Yahoo Finance shows that the average expense ratio for funds like this is 0.36%. So yeah, this is over 10 times lower, and if you compound this over time, it means you're saving a lot of money. Like we're talking thousands and thousands of dollars. So now let's take a look at what types of holdings are in this fund. You can see that most of their holdings are actually in technology at 22.29%, communication services at 11%, healthcare at 15.6%, and financial services at 13.77%. The average PE ratio is 17.91, and the average price to book ratio is 2.68. Some of the biggest holdings in this fund are Microsoft, Apple, Amazon, Facebook, Alphabet, even Berkshire Class B. It makes sense that these make up the biggest proportion of this fund because they are America's largest companies. So what is VOO's purpose? Well, it seeks to track and replicate the performance of the S&P 500. And it does that by investing in all, or at least most of, the stocks that are in this index. It also holds stocks proportionately to its weight in the index. VOO is the single stock that Warren Buffett would be most proud to see you buy. He has always said that the majority of your portfolio should just be an index fund, and a small number should be stocks and bonds that you choose yourself. He's a big believer of funds just like this, and so should you. You can buy shares of VOO through any exchange, just like a regular stock. If you do want to invest with a Warren Buffett style approach, a stock like VOO is one of the best that you can actually choose. It's good for long-term growth, it's less risky, and it's just like a buy it and leave it type of approach. You can focus making your money elsewhere. Next up on my list is Alphabet, stock ticker GOOGL. Alphabet is the parent company of Google and is one of the biggest companies in America. Before we get more into this company, let's go through their stock price. So Alphabet is currently trading at $1,354.50 with a 52-week low of $1,008.87 and a high of $1,530.74. So you can see that it's about 12% down from its all-time high. Alphabet currently has a PE ratio of 27.24, which is higher than the previous years due to the lower earnings as a result of coronavirus. If we zoom out on the chart, we can see that they saw a big dip in February and March, but then gained a surprising 15% in April. Alphabet has a market cap of $923 billion and a beta of 1.06, meaning that its volatility is average. So who is Alphabet and why are they one of the biggest companies ever? Let's take a look at some of their subsidiaries. They own companies such as Calico, Nest, Waymo, Google, and a lot more. Under Google, this is where the bulk of the revenues come in. Google is the largest search engine in the world with about 73% of the market. This means that they are incredibly powerful and profitable, as it can actually sell ads that are seen by billions and billions of people. They're able to really target ads based on what people search and have different companies actually bid on these keywords. And all they have to do is simply put that company's link at the top of the search results. Other than their Google search, they also own YouTube, which, believe it or not, is also one of the biggest search engines in the world. YouTube actually brought in about $34 billion of ad revenue in the last 3 years, and they're expected to grow much more in the long term. As of right now, their revenues are down because of coronavirus. There are fewer companies buying ads, and that causes a big hit because ad revenue makes up over $100 billion of the revenue each year. However, YouTube ad revenues actually increased by 33% this last quarter. And this is because more and more people are just staying home and watching lots and lots of YouTube. In other news, Alphabet has already said that they will be hiring less people this year and they will be spending less money on capital expenditures. This should help them soften the blow from the lower revenues due to coronavirus, but it could also limit their potential growth in the long term. Let's take a look at Alphabet's financials and you'll see why Warren Buffett would like what he saw. Alphabet currently has a profit margin of 20.71% and an operating margin of 21.69%. Both of these numbers is quite high. Their return on equity is 17.83%. This is calculated by dividing the net income by the shareholders' equity. A higher number is better, and 17.83 is quite high. So that means that they are effectively using their assets to create profits. Let's also take a look at the revenues for the last year, which we can see is at $166.6 billion. And with that revenue, they have a gross profit of $90 billion. We can also see that their revenues and earnings have done quite well for the last 4 years. However, it did miss 2 of the last 4 earnings estimates. Based on its balance sheet, Alphabet has $117 billion in total cash and a total debt of $16.8 billion. Their debt to equity ratio is 8.25, and they also have a very strong current ratio of 3.66. Pretty much no chance of Alphabet ever going bankrupt. Now, would Warren Buffett necessarily buy the stock right now? Well, we're not too sure, and maybe not, but he would fall in love with this balance sheet. I mean, with their total assets at $275 billion and total liabilities at just $75 billion, that means that Alphabet is in a very strong place financially. Overall, Alphabet is a very strong company with good forecasted growth, and its relatively good performance during a time like this shows that it will continue to grow stronger and stronger. Consider this stock if you like companies that are more long-term and have really strong financials. But yes, the stock price on this is quite high, making the entry into this stock difficult for a lot of people. Guys, besides investing in stocks, if you want to be like Warren Buffett, you need to save up some cash. It's extremely important to have some cash on hand, one for your own financial security in case something happens that's unexpected, such as a loss of income, and two, to take advantage of any possible buying opportunities that arise. Since the start of Berkshire Hathaway, Buffett has always carried a considerable amount of cash on hand. Yes, he is able to invest in companies a little bit differently than us, but still, it's because of his fundamental investing style of buying companies that are currently selling for under what they should be selling. So yeah, these are just 3 stocks that I thought I would analyze with a Warren Buffett frame of mind. These stocks aren't necessarily what he would currently buy right now, but they certainly fit a lot of the criteria he looks for when investing in companies. If you're still new to investing and want to follow Warren Buffett's advice, stick with VOO, buy it and leave it and be done with it. I guarantee you that that's going to be a lot less stressful than handpicking all your stocks and checking the prices each day. Because with VOO, most people just buy this and forget about it. They don't care if it goes up, they don't care if it goes down. All they care about is what it's going to be worth in like 30 years. So yes, it is a great investment in the long term, and it's a great way of believing in the American economy. Overall, Buffett really stresses that America has gone through some really tough times, but we've always emerged and come out stronger. So if you are investing in the economy as a whole with an S&P 500 index fund like VOO, then if America goes up, so does your money. Hey, if you guys haven't signed up for WeBull yet, make sure to do that. They are giving away 2 free stocks worth up to $1,400 when you open up an account and deposit $100 or more. I use this app for my own trading, and they are very good, simple to use, and free to use. I'll include a link down in the description of where you can actually get those 2 free stocks. And guys, before you invest, make sure to do your own due diligence. Do your own research and form your own conclusions about specific companies. I am not a financial advisor. This video is just for entertainment purposes, but I hope you guys got some value out of this video and learned about these 3 stocks and why I think they are good. Make sure to like and also subscribe to my channel if you want to see more reviews just like this. I make tons of content about investing, personal finance, and entrepreneurship. That's it for this video. I'll see you guys in the next one. Peace.